Welcome to the deep dive. Recently, we came across rethinkingerie.com. That's the site from Don and Susie Karstedt. They're based up in Lake Tapps, Washington. And, well, their take on building real estate wealth, it really caught our attention.
Yeah, they have this great analogy, the tortoise and the hare.
Exactly. And it just clicks, right? It shows these two, totally different ways to invest.
It really does. And Don and Susie, they seem to cut right through all the usual hype.
Right.
They lay out why the slower strategy, focusing on rental properties, often ends up being, well, more powerful for building actual sustainable wealth.
Compared to flipping houses, which is much faster paced.
Exactly. So that's our goal today, really, to dig into their thinking, understand why they argue the rental tortoise often wins that long race.
Okay, let's start with the hare then. House flipping. It definitely gets the spotlight, doesn't it?
Oh, absolutely. You see it everywhere. Big transformations, quick money, allegedly.
And Don and Susie get why it's tempting? That idea of a fast turnaround, maybe a big payout.
But, and this is key to their perspective, they really unpack the downsides. The things you maybe don't see on TV.
Like hidden costs.
Yeah, exactly. Unexpected repairs. They say it's almost like a given. You budget for A, B, and C, but then you open a wall.
Uh-oh.
And suddenly you've got D, E, and F to deal with too.
Yep.
And those costs just chip away at your expected profit.
Makes sense. And it's not just the surprise repairs, is it? They also talk about holding costs.
Right, which can be brutal. While you're doing the work, while it's sitting on the market, you're still paying.
What kind of things?
Well, loan interest, obviously. Utilities, property taxes, insurance.
Okay.
Every single day, those costs pile up. So the longer it takes to flip, the smaller your potential profit gets.
And then taxes. That's another thing Don and Susie flag.
Oh, yeah, a big one. Because profits from a quick flip, often taxed as just regular income.
Not capital gains.
Not usually, if it's your main business or done quickly. So that could take a huge chunk out. What looked great on paper suddenly shrinks quite a bit in your bank account.
Wow. Plus, they mentioned market risk, right? Flippers are really exposed.
Totally exposed. If the market hiccups, if prices dip even a little, or if buyers just get hesitant,
your profit could vanish.
Or worse, you could end up losing money. It's high stakes. Don and Susie kind of paint it as needing everything to line up perfectly.
Which sounds stressful.
Extremely. It's a lot of effort, a lot of risk, and very dependent on timing and things outside your control. Not ideal for consistent wealth building, in their view.
Okay, so that's the hare. Let's switch gears to the tortoise. Holding rental properties.
Right. The tortoise's game, as Don and Susie call it. They frame this as, much more steady, reliable, the path to long-term financial security.
And the benefits they focus on are more about that slow, steady growth.
Exactly. First off, just the basic fact of consistent monthly rent coming in.
Yeah.
That regular income provides a foundation. Something flipping just doesn't offer in the same way.
And the tax side looks different, too.
Very different. Don and Susie really highlight this. With rentals, you get deductions year after year.
Like what?
Mortgage interest, property taxes, insurance repairs, property management fees, even depreciation.
It's depreciation, right? You can write off a portion of the property's value.
Correct. And those tax advantages add up over time, significantly reducing your overall tax burden. It's a huge long-term benefit.
Okay, so income, tax breaks. What else?
Equity building. This is a big one for Don and Susie.
How does that work again?
Well, your tenant pays rent. You use part of that to pay the mortgage. So essentially, your tenant is helping you pay down your loan.
Ah, so you own more of the property over time.
Precisely. It's this quiet, almost passive way your wealth grows in the background.
And then there's just the property value itself potentially going up.
Right, appreciation.
Oh.
Don and Susie point out that good real estate tends to increase in value over the long haul.
And with rentals, you benefit from that often without doing much extra work beyond just managing the property.
Exactly. Time becomes your friend.
Now, Don and Susie are realistic though, right? They mentioned it's not always instant positive cash flow.
Oh, absolutely. They make that very clear. Early on, especially with a mortgage, your cash flow might be small, could even be negative for a bit.
Negative, like you're putting money in each month.
Sometimes, yeah. Their examples show this. But their whole point is the long view. It's not about getting rich next month. It's about building serious wealth over years, maybe decades.
So it requires patience.
A lot of patience. It's a marathon, like they say, not a sprint. But the finish line is potentially real financial independence.
To make this concrete, they shared a couple of examples, didn't they, from investors they worked with?
Yeah, two interesting contrasting ones. One was local, here in Washington. An older place, maybe 44 years old,
Okay.
needed about $20,000 in work right off the bat. And the projecting cash flow, actually negative, like minutes $600 to $700 a month initially.
Ouch.
Yeah. Plus, they mentioned it was a super competitive market, bidding wars, and Washington has pretty strict landlord laws, more tenant-focused.
Okay, so that's one scenario. What was the other?
The other was out of state, Idaho, I think. Brand new property, move-in ready, no immediate repairs needed.
Sounds better already.
Well, the early cash flow was still negative, but less so. Maybe $200, $300 a month.
Okay.
And interestingly, builders there were offering incentives, and the landlord laws were seen as more landlord-friendly.
So two very different properties, different locations, different initial numbers.
But what's the common thread Don and Susie point out?
Neither one was perfect immediately.
Exactly. Neither was a home run from day one. The local one had bigger upfront costs and that higher negative cash flow.
Right.
The out-of-state one meant managing from a distance, still starting in the red slightly.
But Don and Susie's point is, both were starting down the path.
Yes. Both were positioned to eventually get those long-term rental benefits we talked about. Tax advantages starting right away, rents likely rising over time, the loan balance going down, and the property value hopefully appreciating. Wealth building.
And they said something about reaching break even.
Yeah, that's kind of the magic moment. Once your rent income covers all your expenses, including the mortgage.
Things start looking up.
They really do. From that point on, it generally tends to get better and better. You start generating actual positive cash flow.
And you're not constantly chasing the next deal like a flipper has to.
Precisely. It becomes much more sustainable, less frantic.
This gets into what Don and Susie call the slow magic of rentals.
Yeah, I like that term. They explain that even if you start with negative cash flow, think of it as a temporary thing, a speed bump.
Because rents tend to go up over time.
Usually, yes. Inflation, demand, rents gradually increase. So that negative cash flow often shrinks and then turns positive.
And those tax write-offs, even if they seem small each year.
Over 10, 20, 30 years. Don and Susie stress how powerful that cumulative effect is. It really adds up and boosts your overall return significantly.
It's a completely different mindset from flipping.
Totally. Flippers are always on the hunt. Find a deal, fix it fast, sell it quick, find the next deal. It's constant churn.
Whereas the rental owner is... what? Building assets more quietly?
Pretty much. Building equity, building a passive income stream. It creates stability, predictability, more options for the future.
So when Don and Susie weigh it all up, their conclusion is pretty clear.
Yeah, it really is. Flipping might give you a quick win here and there if everything goes right.
But
the patient, consistent strategy of buying and holding rental properties, that's the one more likely to build substantial, lasting wealth, according to them.
the tortoise wins the race.
That's their bottom line. And they add a great line on their site, something like,
Slow and steady doesn't just win the race.
slow and steady, retires early, travels often, and sleeps soundly.
I like that. It's not just about the money, it's about the lifestyle it enables. Freedom, peace of mind.
Exactly. It's about building that foundation.
So they leave us with a kind of call to action or maybe a point of reflection.
Yeah, pretty much directed at you, the listener. If you're considering getting into real estate investing or maybe adding another rental.
What should you do?
They really urge you to take a hard look at where you are now financially, and just as importantly, where you want to be long term. What are your actual goals?
So it comes down to a final question for everyone listening, based on these insights from Don and Susie Parstead at rethinkingre.com.
What race are you running right now in your own wealth-building journey?
Is it the fast-paced sprint of the hare or the slow, steady marathon of the tortoise? And maybe more importantly, is that race truly taking you where you want to go?